p.m. live from our studio in New York City. Happy Friday, everybody. I'm Julie Hyman. That's Josh Lipton. This is Yahoo Finance Live, and here is what we're watching this afternoon. Markets limping into the close on Wall Street with just an hour left in the trading day. The major averages pulling back from their run higher. That's after New York Fed President John Williams threw some cold water on hopes the Fed will be cutting rates soon, saying the central bank hasn't talked about them yet.
And DocuSign shares spiking on a Wall Street Journal report that the company is considering putting itself up for sale. Company thriving during the pandemic, but this year it's a different story. That stock is basically flat. We've got that latest straight ahead.
And our week-long look at the top stories of the year, it's coming to a close this hour. We'll tell you what's the top story for Yahoo Finance this year and how to invest around it. Let's get you up to speed on the market action right now. Coming to a little bit of a muted ending for this week after we had that enormous enthusiasm after the Fed commentary. Now coming back down to earth here. We've got the Nasdaq up just 0.25% today. The S&P and the Dow in the red by between 0.1 to 0.2%. Technology stocks doing the best today, as evidenced there by the Nasdaq. Real estate and utilities and financials, though, are coming down a little bit. They, of course, had seen big pops earlier in the week as we saw bond yields come down sharply. But now some of those moves reversing today, or at least moderating.
The Fed signaling its most dovish tone yet in its economic projections for the next year. Central bank factoring 75 basis points worth of rate cuts in 2024. But we're seeing some backpedaling today, Julie. So more Fed speak to think over, and it does get kind of interesting. So earlier this week, as we talked about, Fed Chief Jay Powell, takes the mic. And at least what markets heard from Fed Chief Jay Powell was, okay, the pivot is here. And cuts are coming. Clearly maybe caught some folks by surprise. Big rallies, stocks and bonds. Here comes the party. Then, first thing this morning, though, we hear from New York Fed President John Williams on another network. He makes some headlines, and he kind of throws some cold water on this, potentially saying, we aren't really talking about rate cuts right now, he says. And sure, yes, we're considering cuts. Of course we are. We're central bankers. That's what we do. But we have to keep all options on the table, he says. And that was just sort of an interesting response.
Yes. And
I think investors are trying to make sense of what that suggests. Does that suggest some maybe dissension, disagreement within the Fed? Or was it simply John Williams coming out and trying to calm markets and saying, listen, cuts might be coming, but maybe not as soon or as deep as you might think. And that basically, we're the Fed, we're still in control.
To be clear, as we talked about yesterday, sometimes what Powell says and what the market hears are two different things. And we should also say what the expectations were going into the Fed was that he was going to push back relatively forcefully against this perception on the part of the market that cuts were sort of imminent, right? And he didn't push back forcefully.
Right.
But neither did he say they're coming imminently, right? He sort of, as he does frequently, tread that line, and then the markets read into it. So here comes Williams, kind of doing that job of saying, okay, slow down.
Right.
And by the way, Raphael Bostic of the Atlanta Fed doing the same thing in an interview with Reuters. He votes on monetary policy next year. He doesn't vote this year. But now we know which dot he is on that dot plot. He said 2 rate cuts could happen next year, but they wouldn't start until the third quarter. So he's in a little bit more of a hawkish camp there. But then we have to make it a little more complicated because Austin Goolsbee talked to the Wall Street Journal, and he said the Fed really needs to start paying more attention to the labor market here. And he's concerned about a climb in the unemployment rate. So he's more on the dovish side of the spectrum. So what does this all equal? I don't know.
Maybe is it just like don't complicate it, and that easing is coming? You don't know when.
At
you don't know how
some
deep.
point.
And if you own risk assets, that's a tailwind.
Or maybe when the Fed says it's data dependent, maybe you believe the Fed that they nobody. Look at the year we just had. To say that the Fed knows exactly when it's going to cut rates, or that the market knows exactly when it's going to cut rates, is a fallacy. And because we didn't know coming into this year what the economic trajectory was going to be. So, we can game it out. People can place bets in the market as they will. At the end of the day, you can't entirely predict this stuff, whether you're in the Fed or whether you're watching the Fed.
No, keep it simple.
Yeah.
All right, let's hit some trending tickers here. Shares of DocuSign, they are popping in today's trade. Look at that, over 11% now. It's after the Wall Street Journal reported the e-signature company is exploring a sale, Julie. So that's what we get from the Journal here. This would be obviously potentially a big leverage buyout, right? This is, I think, the market cap last I looked, something like $11 billion. No sign yet here of who might be curious. Is it a big platform, a tech company? Is it private equity? Obviously, you talk about DocuSign. It's a company we all know because it all became very popular during the pandemic. If you were home, you were looking to DocuSign to get those signed deals and contracts virtually. Then, of course, when we returned to work, you saw demand normalize a bit, and that stock was doing a whole bunch of nothing so far this year, though popping, of course, on that headline.
Yeah, we had a management change in the past year or so within this company because of its sort of come down post-pandemic. It still, has done well if you look at it over its life cycle as a publicly traded company. It came public back in 2018, I think at around $26 a share, something like that. So obviously it's done well, but it's nowhere near the highs where it was during the pandemic. So hence perhaps this desire. It is interesting specifically that the Journal is reporting it could be a leveraged buyout. In other words, it's not a strategic acquisition by another company necessarily. PE has been less active this year. So that would represent a big LBO if that indeed was going to happen. So we'll see.
I will say Rob Owens, who's a very smart guy over at Piper, he covers this name hot off the presses. He's telling his clients he wasn't surprised by this because he pointed out the cheap valuation, really. Who could be interested, Rob is saying, maybe a larger platform, but he sees also potential for PE to step in because he just thinks there remains, in his words, further opportunity for margin expansion, given just kind of the current state of DocuSign's business. One to watch for sure.
Definitely. Let's talk about Chinese stocks today because we're seeing tech shares like Alibaba and JD.com trading higher and even holding up as the overall market pulls back. China announcing new stimulus measures to support a slowing economy. And, there's been this whole debate this year about how aggressive China is going to be with some of these stimulus measures to combat the slowing economy. So what happened was a lending facility, 1-year loans to commercial lenders, $112 billion from the central bank sort of being pushed out into the Chinese economy.
Which I read that was actually a record cash injection.
Yes, exactly. So it looks like they're stepping up a little bit. There was also a relaxation of home buying curbs in certain cities, the biggest cities, Beijing and Shanghai. And so all of that, not specifically to Chinese tech, but seeing kind of a lift overall there because of this news.
Yeah, I guess listen, the Chinese economy has been shaky. You can see it in the retail sales. You can see it in the home prices. But I guess if you want to bet maybe stimulus is coming, more stimulus in 2024, then you maybe get more confident to commit capital to some of these names. But it has been rough sledding. I mean, Baba is well in the red this year. JD is even worse. That stock's lost about half its value in 2023 now. Yeah,
I guess one of the stocks that has continued, I believe, to do well this year, PDD, up 82%, the owner of Temu, right, which has been one of the runaway hits this year. So that's been an interesting outlier. One outlier today that I wanted to mention, linked to this story, is XPeng. So those shares are not participating in some of the lift we're seeing for some other companies. And that's because Alibaba is a shareholder in XPeng, and it said in a filing that it's Taobao China, which is the one that holds the XPeng shares, filed to sell 25 million of those shares effective today. So that's why we're seeing XPeng move in a very dramatically opposite direction from some of those other shares.
All right, and here's another one that's trading lower. Check out shares of Lennar trading down today. That's after reporting a weak gross margin forecast for 2024. You can see down about 4%. So this is kind of a rough recession, although we should mention it's off its lows now. And we should also mention, you got to keep in mind the kind of year Lennar's had. I mean, even now, with this sell-off today, that stock's still up nearly about 70% this year. Because home builders we talk about a lot, and just the powerful moves these have had. D.R. Horton, KB Home. And I guess listen, you look at this print though in particular, they did report better than expected orders, it looks like. Looks like they forecast about 80,000 deliveries in fiscal 24. It's about 10% higher from what I'm reading versus what got delivered in 23. But it sounds like we can pin that disappointment on the gross margin.
Yeah, and it looks like what they did was they sacrificed gross margin to push that order growth, perhaps. So is that still going to happen? Some commentary from the call that was interesting. The company saying that extreme use of incentives looks like a thing of the past. So maybe that's a little bit of a signal to the street that margins might get a little bit better here. So we'll see what happens from this trajectory. Obviously, also rates going down is something that eventually has got to help the home sales picture. Well, let's talk more broadly now. Despite the rocky moves on Wall Street today, the major averages are on track for their 7th straight weekly gain. Joining us now, Drew Pettit, Citi U.S. equity strategist. And Drew, I want to talk to you a little bit about your outlook for next year. But first, I got to ask you about these past few days of hearing from Jay Powell and then Fed speak and kind of how the market is reading it. How are you reading it?
Look, I think this is supportive of equity markets and honestly supportive of our constructive outlook for the S&P 500. Just where we get a little bit concerned is you're probably pulling forward a lot of good news at this point. So look, at the end of the day, we think it's constructive. We think equity markets move higher from here, but we're pricing in some good news. So we'd rather buy pullbacks rather than chase rallies.
And Drew, when you say constructive, so the SPX, the S&P 500, a year from now, Drew, where do you think we are, and how dependent is that call on the Fed cutting rates next year?
Yeah, so look, we're looking for 5,100 on S&P by December of next year. So we kind of phrase this interestingly. Yes, the Fed is supportive. Yes, it should help us hold the multiple at about 21 times, but it only influences, it doesn't determine our call. So yes, lower rates, that's going to help the cross-asset valuation picture, which has really, really improved as of late. But at the end of the day, we think earnings growth in fundamentals is what's going to drive this market higher. At the end of the day, we think the multiple stays where it is, and we have 10% earnings growth, which drives upside from here.
And Drew, talk to me about the relationship between earnings growth, economic growth, and then also throw in the outlook for rates on there.
Yeah, so it's a little complicated. That's how we kind of spun this in our outlook. So yes, the economy does help earnings. We can't deny that, but it doesn't determine it either. So the S&P isn't the economy, and we kind of fight this battle internally and with a lot of macro-focused investors all the time. But we're getting a lot of productivity gains, which helps push earnings higher, even if we have a macro slowdown. This is definitely something that is more concentrated in the S&P compared to what we've seen in more cyclical sectors, or even when we move down into small cap. So at the end of the day, yeah, we could have slowing, but we're going to get efficiency gains. That's what's going to help drive earnings. That's what's going to help drive the market.
And Drew, this is your call coming here as we've already seen, obviously, a nice rally in the market. So I'm interested to get your take on valuation as well. You obviously must think it's constructive still?
Yeah, so look, I hate when people start talking about the S&P in historical context. Yeah, look, I'm a student of history, but we can't just say we're going to trade at a 16 times multiple because that's what the S&P's been average since 1940. Okay, great. Well, the S&P isn't the same as it was in 1940. We have much higher growth companies. They have better margins. They have better secular tailwinds. When you put that all together, and you think about where we are with interest rates, their decline of late, where we've come from a high point in inflation to where we are today, in our still resilient earnings outlook, honestly, 21 times is not unreasonable for this market. We think that's fair value. Where the Fed comes into play, if we get more than 75 to 100 basis points of cuts, say we do get 150 basis points of cuts like the market's pricing in for the Fed next year, it's actually possible you could see 23, 24 times on the index.
Interesting. Why would that be then? I mean, because if they're cutting more because, say, unemployment is going up,
here's where it gets a little bit messy with the macro.
Yeah.
If they're cutting to try to normalize because inflation's come down, but earnings growth is still constructive for the largest cap companies in the US, you can possibly re-rate them without having to collapse earnings growth. To your point, and this is what's honestly likely more plausible, if we get 150 basis points of cuts, there is going to be macro weakness. You're probably going to bring in earnings forecasts in that scenario. But what's constructive for investors, if we get more severe cuts in interest rates, it will help support the market even if earnings move lower. So that's why we think you can have a higher floor under the index in 2024.
And Drew, as if it wasn't complicated enough next year between the Fed, the economy, we also have to think about the election. That's another variable to consider. I'm interested just to, as a strategist, how do you think about that dynamic?
What keeps us up at night is fiscal impulse. So admittedly, rates coming down helps lower the interest burden that the U.S. is paying on its debt. But we are concerned that into 2025 and beyond, you might not see as many tailwinds from government spending. On top of that, we're talking about productivity in a really positive light when we talk about S&P 500 earnings. But the more productivity gains you have, it's at the expense of labor. So as labor kind of loses to capital, and potentially even more the year ahead, then you start bringing up, I'm going to say, just you're going to put a big target on the back of big corporations. Labor's not winning, but you're winning more. All of a sudden, I think the election rhetoric from both sides might not be as positive in that situation once we get closer to the presidential elections.
Very interesting, Drew. So it sounds like, and I like this in your note as well, you acknowledge there are a lot of variables, and what the past year has taught us is it's tough to do what you do and forecast what happens in the market. So how do you sort of hedge, right? Hedge your view. I noticed that you say on dips you would get a little bit, take the opportunity to increase your defensive positioning. Talk us through that a little bit.
So actually, yeah, we would add select defensives on pullbacks, but what we're really suggesting to clients is don't go sell your growth winners right now. A really good time to realign your portfolios is on pullbacks. When we get those pullbacks, you could see the Magnificent Seven, a lot of the growth indices and growth stocks and sectors probably outperforming because they're not as directly macro connected. When you have that outperformance is when we want to rotate to cyclicals. Don't buy cyclicals on the rallies. Don't buy small caps on the rallies like we've seen in the past few days. Wait for a pullback, wait for a pause in the market, and use that as a better entry point. I think the action today really speaks to that because you're seeing small cap underperform, you're seeing some cyclicals lag. This is a better time to rotate portfolios than when you have these big 2-3% moves.
Interesting, actionable stuff. Love it. Drew Pettit from Citi, thank you so much. Really appreciate it.
Hey, happy holidays. Thanks for having me.
You too. Thank you. We're just getting started here on Yahoo Finance Live. Coming up, a new installment of our series, Goodbye or Goodbye. We'll look at the banking sector and tell you which stocks to buy and which you might want to avoid. And later in the show, a year of resiliency. We'll dive into the 4 lessons learned from 2023 for startups and what they need to know ahead of the new year. Also today, we're revealing Yahoo Finance's biggest story of the year. We've got some clues for you. It has caused huge market rallies, helped children do their homework, and even contributed to a moral panic. I wonder what it could be. We'll tell you later in the hour. Coinbase denied a push for new crypto rules from the Securities and Exchange Commission. Jennifer Schonberger here with the details on this ongoing story. Hi, Jen.
Good afternoon, Julie. That's right. The SEC denied a petition from Coinbase to create a new regulatory framework to govern crypto asset securities, saying that it's currently unwarranted and disagreeing with Coinbase's argument that applying the current rules would be unworkable. The decision reads, quote, "The commission disagrees with the petition's assertion that application of existing securities statutes and regulations to crypto asset securities, issuers of those securities, and intermediaries in the trading, settlement, and custody of those securities is unworkable." SEC Chair Gary Gensler saying in a statement, quote, "To the extent that crypto assets are offered and sold in the form of an investment contract, the federal securities laws apply." He went on to say the existing securities regime appropriately governs crypto asset securities. The SEC essentially says there's no reason to craft a new regime for crypto and that it's already writing some targeted crypto rules and filing enforcement actions under existing authorities, though 2 of the 5 commissioners disagreed. Republican Commissioners Hester Peirce and Mark Uyeda opposed the SEC's denial. The decision coming after the U.S.'s largest crypto exchange asked a federal court this spring to make the SEC respond to its petition. Coinbase filed that petition in June of 2022, also asking how to register with the financial watchdog and lamenting no response for months. Coinbase set to challenge the SEC's decision, filing in the Third Circuit Court this afternoon. Paul Graywall, chief legal officer for the exchange, saying in a statement, quote, "No one looking fairly at our industry thinks the law is clear or that there isn't more work to do." Back to you.
Jennifer Schonberger, thank you. There were a number of headline-making deals this year. Exxon acquiring Pioneer and Pfizer acquiring Seagen, just to name a couple. U.S. M&A totaling over $1 trillion in 2023. As we look ahead now to 2024, here with us to talk more about the 2024 M&A landscape, Ephraim Kaplan, Brown, Gibbons, Lang & Company Managing Director. Ephraim, it's great to see you on set. Maybe just start big picture. Get your take on the M&A landscape in 2023, and now looking ahead in 2024. You have a lot of different cross currents: financing, election, geopolitical risk. How do you think it's going to shake out next year?
Yeah. Josh, Julie, thanks for having me. Pleasure to be here. Listen, 2024, from a firm perspective, we are quite bullish on the year. Now, granted, we're coming from a point of, I'd say, pretty significant weakness in 2022 and 2023. But make no mistake, we're really looking forward to 24 and moving beyond 23. There are a few risk factors that we're still keeping in mind. Make no mistake, there is increasing geopolitical risk, which enters the equation. Regardless of what the Fed's recent statements are, Wednesday of this week, monetary policy definitely can improve the market, but we are not out of the woods from a recession perspective. So whether it is a hard landing, a soft landing, there is still risk of recession. So these components give some level of conservatism to the market. But when we factor in those and take a look back to 21 and 22, the tailwinds significantly outweigh the headwinds from a 2024 M&A market point of view. It's going to be a strong year.
Something that caught our eye today, the report in the Wall Street Journal that DocuSign was potentially putting itself up for sale, and specifically talking to private equity about a leveraged buyout. It's an $11 billion company. We have not seen that much activity of size on that front this year, in part probably because of the rate environment. So specifically, talk to me about private equity and potential LBOs next year.
And so there's a lot in there. Yeah. So I'll try to boil that down to a couple components. One, which if we want to talk in a little bit about, is just the health and foundation of just investing. Regardless, again, of what the Fed did from a cost of capital point of view, the market and the components of the macro economy that are much better now than they were in 21 are helping from a foundation perspective. And companies generally have been battening down the hatches for the last couple of years, improving balance sheet, improving P&L, just provide a better footing for new capital coming in to invest over the long term. So while we're thinking recession here in 6 months or maybe no recession, private equity is a little bit of a longer term investor. So unlike the public market, the public capital markets, which are very quick, very liquid, high velocity, private equity is longer term. And I think earlier this week or late last week, Bloomingdale's there was an announcement on Bloomingdale's or Macy's about another leveraged buyout by a large private equity firm.
Yes.
So I've been in this business for 25 years, and the amount of publicly listed companies has decreased in the past 20 years by 50%. There are 5,000 private equity firms, 30,000 companies owned by these private equity firms, and the sophistication and the importance of private equity in investing and pushing businesses forward, the risk-reward pendulum to private equity has been quite impressive. And so we are seeing private capital, and we've heard about private debt and the advancement of private debt. We haven't talked about nearly as much how important private equity is in terms of providing the retail investor, the institutional investor, a better risk-reward dynamic. And so you see these happening a lot. And when you look at the data and you look at the stats, you'll wonder, where is the merit to invest in public equities versus private equity?
And let me ask you another variable to consider. If you think about next year, we talked about financing costs and geopolitical risk. Another one is the regulatory backdrop. Lena Khan over the FTC, much more aggressive than predecessors. How does that sort of factor into your outlook for next year?
So, if we think about the 2024, you would typically expect large cap M&A to lead. We looked at there was potentially the Cigna Humana deal that obviously got derailed. That deal could have opened up, who knows if it would have got through DOJ, but it could have opened up a lot of payer activity. Large cap M&A pushes small cap M&A. It pushes more M&A generally. We've seen one of the sectors very key to our firm is essential services and infrastructure. We have seen large companies question whether or not to do large cap M&A versus moving towards much more cottage industries, smaller deals, can move through DOJ a little bit quicker because they just don't want to deal with the antitrust dynamic. So there is absolutely a component in the calculus in 2024 whether or not those deals will happen. Now, what I will say is, with the prospect of a recession, which is again why we're bullish on M&A, if you're going to hit your earnings targets and you got this pressure to perform, and you see recession ahead of you, and so your ability to continue to grow top line is somewhat limited, there's M&A to push that forward. So from an antitrust point of view, you're probably going to be more selective in terms of which deals you do, and who knows if private equity will really take that share from other large corporates doing larger deals, but it is an issue.
And finally, in the last 30 seconds, if we're looking at the public company landscape, what sectors where do you think we're going to see most activity?
Tough to answer that in 30 seconds, but I will say, so just a few deals to mention. You have CVC buying Diff Partners out of the Netherlands. You have Bridgepoint buying ECP, which is a Seoul and US-based private equity firm. They are infrastructure-focused funds that are getting acquired by multi-asset, multi-region, large asset managers. So infrastructure, similar to the past few years, which has been a very strong asset class. Infra, as well as essential services, is a very strong asset class. I'd say we are bullish on tech. We're excited about our tech business. It's really had a tough run these past couple of years. Tech, fintech, infratech, general software, we're very bullish about. Healthcare has been a very stable business for the firm across M&A and capital markets. So those are three sectors we're pretty excited about.
Right. That was maybe not 30 seconds, but that was quick. That was good.
All right, great.
Very succinct.
Thank you. Thank
Ephraim
you very
Kaplan,
much.
thanks for being here.
Yeah.
Really appreciate it. Happy holidays to you.
Thank you for having me. Appreciate it.
Coming up, a new installment of our series, Goodbye or Goodbye. We're going to look at the banking sector and tell you which stocks to buy and which you might want to avoid. It is a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye, brought to you by E-Trade from Morgan Stanley. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today's focus, the banks. After the chaos caused by the collapse of Silicon Valley and other regional banks in the first part of the year, regional bank stocks collectively have recouped those losses. The conventional wisdom was that the big banks would be better positioned following that crisis. Today's guest is turning that on its head. I'm here with Bob Elliott, CEO and CIO of Unlimited. Thanks so much for being here,
Thanks
Bob.
for having me.
So you actually like a regional bank stock, and you have a mega cap bank stock that you don't like. So let's get to the regional bank stock. It is Comerica. And this is a regional that did get caught up. We can certainly see it on the chart. It got caught up in what was going on with SVB earlier in the year, had deposit outflows like many of its peers. So you're looking at it now for a number of reasons. One of them is, on a relative basis, you like the valuation of Comerica.
Well, I like the valuation a lot. You've got one of the regional banks that's trading, at a 6 PE, which is one of the lowest PEs amongst the regional banks. And the stock is still down, 20 or 30% from pre-SVB conditions, when you're seeing a real stabilization in the overall economics of the business. So it's not clear that decline in the stock price makes a lot of sense, particularly in the context of some of the buoyancy we've seen in other stocks, which of course we'll get to a little later.
And again, collectively they've recovered, but Comerica, to your point, hasn't. Why has it been punished so much more than some of the others?
Well, I think one of the challenges is some of these smaller regional banks are in a difficult position to absorb a lot of this incremental cost around new regulatory frameworks and things like that. That is something that's hindered the stock operating as an independent, but given where it's positioned and where it is relative to all these other sort of smaller regionals, it actually may be a good opportunity for an acquisition from one of the bigger ones, particularly when we talk about its geography and its footprint and its growth into Texas and California, high growth markets.
All right, put a pin in that. We're going to talk more about that in a minute. Let's talk about some of the other fundamentals of the business. Effectively, you're seeing it as having a lower risk balance sheet versus the rivals. And one of the things I was intrigued by that you brought us is its non-interest bearing deposit accounts as a percentage of the total and how it compares to the other bank. This is Comerica on the right here. We've got the likes of Zions Bank and some of the others going all the way down. WBS, I don't know. Huntington, I know HBAN, that one.
Exactly.
In any case, these are deposits that they don't have to pay interest on.
Right. I mean, the sort of sweet spot of any smaller bank is traditional business transactions and customer deposits, people who are getting their paycheck deposited, businesses that are, small businesses that are running their day-to-day operations. Those are non-interest bearing deposits, and the more that those banks have, the less that they have to pay on their deposit base. And so you look across, the range of different banks, and you see Comerica is actually very well positioned, even though on the margin, the non-interest bearing deposit, the interest bearing deposits are a little bit higher. When you've got almost half of your deposit base paying zero, you got a lot of good sticky deposits that are there based on a relationship reason rather than looking for the highest yield that's out there in the market.
Right, and they're low cost to you, obviously, as the bank. And then finally, there's the other point you mentioned, that it's growing in places like Texas and California.
Yeah, I mean, Comerica actually is my hometown bank. I'm from Detroit. I grew up in Comerica with accounts there, but in the time since I've left Detroit, it's moved its location, its headquarters to Texas, really banking the Texas boom that we're seeing that's going on. And the other thing that I think is interesting is it made inroads in California. It was actually pretty conservative in the California market relative to some banks that we've been a little more familiar with lately. And that's actually positioned it well. It's got, for instance, one of the oldest venture lending businesses in the country. And it's stepping in where SVB and others are stepping out. And so it's really positioned to take advantage of the weakness in some of the other banks that are in the space. So
given all of that, what do you think is the biggest risk here? It's that maybe we see another hit to these small banks?
Well, I think it all comes down to whether we see a broad-based bank run. Now, I don't think that that's going to happen. And the Fed's made it pretty clear that they're going to do what it takes to ensure that the deposit base remains stable. And what you're seeing actually is deposits have grown since the SVB situation for most of the regional banks, even though they're still declining for the big banks. So it doesn't look like we're going to be in that situation, but of course that's always a risk that's out there for these.
And just quickly before we move on to your goodbye, you hold Comerica?
I don't personally in my accounts or my business.
But it's one that you like. Okay, and then let's get to your goodbye, one that you would avoid. And this is a big bank. We're talking about Bank of America. So it's not as though automatically in your mind, bigger is better in terms of what people should be buying. Here too, we start with valuation.
Well, I mean, you got to think about it. You got two stocks that both were very exposed to the consequences of the SVB crisis. Bank of America, in particular, with a large securities portfolio that they've got to be booking in order to take the capital charges as a GSIB. And so they're facing challenges as a function of that, similar challenges that happened in the regionals. It's just that they're priced about twice as high as what you're seeing in some of the low valuation regional banks that are out there like Comerica. And so when I look at this diff here, we've got essentially the best of the small and the worst of the big.
Got it. Okay. And then also on that front, you're looking at net interest margin from Bank of America compared with that of a Comerica, and you say it does not favorably compare.
Yeah, I mean, Bank of America, given it's a GSIB, should be killing it in terms of their overall deposit costs, but you're seeing that average deposit costs start to move up into the 2 range. That's a lot, given there's so much incentive for big businesses to bank with Bank of America and their national footprint. So that's causing them to see a NIM compression that is, actually not that far off of what you're seeing from many of the regional banks. And I thought this was a nice, interesting contrast that Bank of America, is at 240, Comerica's at 260. You wouldn't necessarily have thought that right off the bat.
Right. And then finally, whereas Comerica is expanding, you're talking about that the business here is not growing. And in particular, you wanted to highlight what we're seeing in loans and leases, which if you look at this over the past few quarters, hasn't gone much of anywhere.
I mean, the whole advantage of being a GSIB is that you should be able to outcompete all of the different regional competitors that are out there. There's a number of other big banks here in New York who have taken advantage of the weakness that has existed through organic growth as well as acquisitions. Bank of America, it's been a flat business for several years now. We look here in terms of the loan book, the wealth management, cards, they're lagging behind many of the other issuers. This is not a great franchise. It's a big franchise, but it's a lumbering, slow-moving one that looks expensive relative to some of the other options that are out there.
And effectively, the risk to your thesis is sort of the flip side of what we saw. If there is a crisis, money might flow into the banks. I want to get to our summary here of your buy and sell case. And by the way, any position in Bank of America okay. So to recap, you are saying to investors you could buy Comerica based on its value against other regionals of a similar size and better balance sheet, plus its potential for further growth as it expands operations, filling the gap that was left behind by the collapse of SVB and others. On the other side, you say maybe you want to avoid Bank of America, high valuations, stagnating net interest margins, despite being such a big player. Bob, thanks so much for being here.
Thanks for having me.
Appreciate it. And thank all of you for watching Goodbye or Goodbye. Have a great weekend. We're going to be bringing you new episodes of this 3 times a week at 3:30 p.m. Eastern. We have been counting down the top 10 stories of 2023 here at Yahoo Finance, and we are finally at the top spot. Coming in at number 1, can we do the drum roll again? It can only be AI, the tech boom.
OpenAI, the research and development team behind viral bots, could see a valuation of up to $29 billion.
I believe that there will be far greater jobs on the other side of this.
Well, the best thing you can do as a CEO to jumpstart your stock is talk about AI.
We're also deeply investing in AI responsibility.
AI is going to change everything.
Is government needed to play a role in regulating AI?
The consequences of AI going wrong are severe.
I mean, when Gwyneth Paltrow says it's going to be changing everything, then that's it. It's been a year. What a year it's been to break down how the biggest players in tech have jostled to be in first place in the AI race. Here's Yahoo Finance's Dan Howley.
To say that 2023 was the year of AI would be the understatement of, well, the year. From NVIDIA and Google to Microsoft and OpenAI, Silicon Valley couldn't get enough. In just Q2, the term AI was mentioned nearly 4 times per earnings call. That's a lot of AI and a lot of investment. Heck, even Wendy's got in on the action, adding a generative AI assistant to its drive-thru. Here are some of the biggest highlights from the biggest theme of 2023, the generative AI explosion. It might have been the most important story of 2023, but it started in November 2022 with the release of ChatGPT by OpenAI. The chatbot quickly became the fastest growing app in history to that point, reaching 100 million monthly users in just 2 months.
OpenAI is the most advanced and the most widely used AI platform in the world now.
On the heels of the bot's success, Microsoft announced it was investing $10 billion in OpenAI. In February, Google debuted its rival chatbot, Bard, but the unveil was light on details. Days later, Microsoft took the wraps off of its OpenAI-powered Bing bot. But Google kept pouring on the news in May, debuting its search generative experience. Microsoft then fired back, revealing it was bringing its AI-powered Windows Copilot to Windows 11. Oh, and in May, NVIDIA's market capitalization briefly topped $1 trillion for the first time, cementing its status as the AI chip leader. In September, Amazon, keen on getting deeper into the action, announced it was investing $4 billion in OpenAI competitor Anthropic. Meta, meanwhile, revealed an AI assistant for its social platforms, as well as AI personalities for celebrities like Tom Brady and Kendall Jenner.
Seriously? How could you not know that?
In November, all hell broke loose at OpenAI when the board fired Sam Altman seemingly out of nowhere. It caused investor uproar. CEOs came and went. Microsoft offered him a job. Hundreds of OpenAI employees threatened to resign. And finally, OpenAI brought him back. But this time with new board members, including a non-voting observer role for Microsoft. A big year for big tech, and no doubt one that will change how we all invest, work, and play forever. And it feels like it's all just getting started.
So that was 2023, but what will be the best investing plays for 2024? Let's bring in Evercore's Mark Mahaney and Brent Braceland from Piper Sandler. Guys, it is good to see both of you. Mark, let's just pick up right there with AI. And obviously, Mark, there's been a lot of companies you cover and know really well that have been putting a lot of time and effort and money, Mark, into AI. I'm curious, within your coverage universe, Mark, are there certain companies that are maybe better positioned than others to really benefit from the monetization of generative AI, Mark? You know, is it Amazon, Alphabet, Meta? How do you see it?
You just listed the 3 companies I was going to pitch. Stole my thunder, Josh. So it's nice to see you again. And let's see. Yeah, those are the 3. Why would those 3 be the companies? Because they've got so much data to work with, and they've also got the capital to be able to invest. And they have been investing for a decade or 7 years in different versions of AI. Amazon's been using machine learning to figure out how to best position packets and parcels within their distribution centers for a long time. We do have a kind of step up in the capabilities of artificial intelligence. There's no doubt about that. I think both as a deployer and as a revenue recipient, I actually think Amazon's really interesting. Your segment started off highlighting the 2 companies that everybody refers to, NVIDIA and Microsoft, and then maybe Google gets some credit for it. But Amazon usually doesn't show up in the conversation yet. They are the leading cloud vendor, 50% bigger than Azure and our our kind of Microsoft's Azure. And our point of view all along has been, generative AI revolution won't be televised. It won't be on-prem. It's going to be in the cloud. And so when people look for ways to really use these large language models, you're going to need storage capabilities, you're going to need compute capabilities, you're going to need infrastructure. And that's where AWS is 60% market share. So I think Amazon's really kind of the best derivative play out this. Probably I'd put Google 2, and I'd put Meta 3, because I think they've had a wonderful number of applications that people have underappreciated, ways they've used AI to already improve the experience for both users and advertisers.
Interesting stuff that all of them have a little something for everyone. I want to turn to you, Brent, because sort of the most obvious one in your coverage universe is Microsoft, right? It's been the loudest with their AI, with what's happened with OpenAI. Is that the obvious play here, or are there others that people should be looking at?
Certainly the obvious play, but for obvious reasons. The way I kind of think about Microsoft, this is their iPhone moment. It was obvious that Apple had an opportunity to capitalize on the iPhone. This is Microsoft's opportunity. Microsoft AI is about a $2 billion business in year one. We think this is going to be a $10 billion business for Microsoft over the next 2 years. So we're just in the early stages of the monetization for Microsoft, but that's not the only company in the application space that is leveraging these large language models. Adobe, for example, has done a very good job in a very short period of time monetizing it. There's more stuff coming next year from Adobe. They're coming out with an AI assistant for their Acrobat products and their Reader products. So I think there's a lot of interesting things that Adobe is doing, as well as HubSpot. Smaller application company, but they're also in a really unique position. They have about 15 different AI features and functions, and they'll be in the early stages of monetizing some of that next year. I would also watch some of the data players. I think outside of the infrastructure as a service players, these database layers could be the dark horse relative to indirect beneficiaries of AI. So MongoDB, Snowflake, these are database layer technologies that actually could see a indirect tailwind as some of these big applications start to get deployed.
Yeah, a little bit like what Mark was saying with regard to Amazon, perhaps in terms of the cloud and where it's happening. I want to dig in on Microsoft for just spend another moment on Microsoft.
Sure.
Because we can't really talk about the big AI story of the year without talking about OpenAI and the blow up that happened at the end of the year. Risks for Microsoft as a result of that relationship? It still feels like we don't have the whole story there of what exactly happened.
Certainly don't have the whole story, and I'm not certainly on here to pretend I do either. But I think it does expose one thing, and that's the dependency on the OpenAI large language model. Now, the reality is most of the infrastructure as a service platforms are all basically align themselves with the large language model, a foundational model. Amazon is obviously working with Anthropic, and Microsoft working with OpenAI. So maybe it's a risk for all of them. Maybe we'll see diversification and a dual source, multi-source strategy over time, but the pace of change is happening so fast. I think you need that alignment. You need that tight coupling between a large foundational model as well as the infrastructure as a service platform.
And Mark, I want to turn it back to you. A question I was thinking about, as you were speaking there, Mark, kind of just a broader question. These big tech companies you cover, Mark, and they're putting this money, this effort into AI, and they're integrating that technology, across their portfolios, their products, their services. Is there a risk, Mark, when we see all these big tech players putting this kind of money into this tech, is there a risk that it gets commoditized in any way?
Why not? I mean, most technologies over time have become commoditized, so why not? I would think that there's that risk. I think you got a couple of years to go before you face that risk. I thought you were going to go in a slightly different direction. What I'm struck by is because there's something else that happened in tech. I mean, we've had a phenomenal year in tech, in part because of the AI thesis. But in all fairness, there's that thesis in terms of actually impacting fundamentals. That's going to take a few years to really play out. We didn't have a recession this year, so that helped. But there was the third thing, which is that we caught cost religion, or I should say tech companies caught cost religion this last year. Meta is a wonderful example of that. But most of these companies laid off some of their employees. That's never a good thing, but they needed to do it. And then it just showed much more of a kind of a maturity, a willingness to embrace what their cost basis should be given where their growth is. Kind of embracing their middle age, if you will. And I think that's sustainable going forward. And by the way, what that means is that they have this kind of extra investment powder if they need it to layer into AI, because AI is expensive. These large language models are expensive to operate, to maintain, to run. And it just so happens, though, that these companies are probably cutting back in investment areas and operating expense areas that were probably a little bit excessive. And it allows them to, that there's more, whatever, the wood behind the arrow when it comes to Gen AI. That's what I find really interesting. That these companies should absolutely be investing in Gen AI, and they have more ability to do it in part because they've become much more careful about expenses over the last 18 months.
And Mark, let's just stick with that. In terms of your picks, I know you like Meta. You've been bullish on it. It's up 180% this year, Mark. Do you stick with that in 2024? Is that a top Mark Mahaney pick?
It is. I've got a couple of companies that are up 100% plus. In fact, in the internet space, there are seven magnificent. Seven. There's the other magnificent seven. There's seven internet stocks. Uber's in there. DoorDash is in there. Spotify's in there. Meta, Duolingo's, a bunch of these names. What I think when you phrase it like that, your knee-jerk reaction, of course, is no. But if you step back and you say, well, let me tell you something about Meta. It's trading at 18 times earnings. So it's trading at a market multiple for what is premium growth. The sector has now had a phenomenal year. Tech had a phenomenal year because you re-rated. Multiples went up because they got crushed in 22. And then you had these estimates revisions that were positive because we didn't have a recession. And then you had good compounding growth. I think going into next year, you're not going to get the re-rating, except for a few cases. And I think Amazon still can re-rate. But you're going to get this really healthy compounding driven from kind of consistent or better demand trends, flattish expense basis, so rising margins. So that's what I think is so interesting about big tech going into next year. It's back to the old compounding reasons that you like big tech, successful tech, not all tech, but the high quality tech in the first place. This is going to be the year of compounding. And I think that means that group is going to continue to outperform, just not by as much as it did this last year.
So I'm gonna take that as a jumping off point and finish with this for both of you. Brent, I'm going to start with you on this. If this was the year of AI, 2024 may be the year of compounding, but I would imagine there'll be a bigger story or a bigger narrative as well. What do you think? What's your best bet for what that's going to be?
A couple different things. When I think about next year, I call it a feature flood. We're going to see an AI feature flood next year where these models are democratized. Everyone has access to these foundational models. And so we're going to have a feature flood of AI functions and features that every application vendor, every internet company will have. And so it's going to be confusing to understand which of those are adding value, which of the companies can monetize. So I think that's definitely a theme that we're thinking about next year. I'm going to dial it back a little bit and look at the broader tech space. And if you look at the cloud 100, the 100 largest cloud companies, their growth profile has been cut in half over the last 2 years. We had the pandemic digital bubble, big spending increase. We've been optimizing the cost for 2 years. As we look at our CIO survey this week, you're seeing spending intentions go up meaningfully. And so as I think about a new narrative for next year, it feels like we could actually have a recovery in the cloud space.
And Mark, what about you?
I think Brent just nailed it. I think we are mostly through this. Yeah, I think mostly through this optimization cycle. So, I look at like 9 different verticals. Cloud's one of them. Cloud's accelerating next year. By the way, so is advertising next year because you got the Olympics and the elections. And then on the first point about the rollout of generative AI, yeah, we're all looking at the infrastructure, but the app layer, that's what we're going to see. Like, so what did you actually come out with? Like, how did you improve your products and your processes? I think we're going to see that. It's an increasing number of examples of that. By the way, I think I mentioned this earlier about Meta. The Facebook and the Instagram user experience for all of us who use it, which is just about everybody, it's improved materially. It's changed materially. It's become much more of a media rather than a social company. And AI has helped them to do that. By the way, it's also improved return on ad spend for marketers. That's why the fastest growing, even though it's one of the largest, fastest growing ad asset right now is Meta. So the applications are there, and I expect to see it in a bunch of other companies. Spotify's got this AI DJ. I want to see Netflix's AI video DJ, whatever VJ. And there's a bunch of other examples like that, but I think we're going to get more and more of these rollouts. So AI is going to be a theme that keeps on giving for a couple of years here.
I'm not totally sold on that Spotify AI DJ yet, but maybe I got to give it another shot. Mark Mahaney, great to see you. Brent Bracelin, thanks so much for coming into our studio. Really appreciate it to talk the outlook for next year as we look back on this year. Thanks so much, guys. Coming up, the closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned. There it is, the closing bell on Wall Street on this Friday here, closing out the week for the major averages. So let's do a quick check of the markets here and see where we are ending up on the week for them. We've got the Dow trading higher about not even 0.2% here for the Dow Jones Industrial Average. Just checking the weekly move here, up about 3% on the week for the Dow. It is indeed the 7th straight week higher for the Dow Jones Industrial Average. The S&P 500 on the day dipping a little bit, but still up 2.3% on the week, and that's good for that 7-week winning streak as well. And then finally, checking the numbers on the Nasdaq, it also ending the day higher, ending the week higher by 2.9%. So obviously the momentum continuing here on the week, helped in large part by the Fed on Wednesday and what was seen as a much more dovish tone coming from Jay Powell. Just checking on some of the other weekly numbers, by the way, for the sectors. Real estate, materials, industrials, consumer discretionary, financials, all of them higher on the week. And effectively, part of that is because of lower interest rates. Part of that is because they're cyclical. So if things are going to be reaccelerating or, being okay in the broader economy, then that's good for those. I should mention, I'm just seeing some other numbers here. The Nasdaq 100 closing at a record in today's session. That's the first time we've seen a new record for the index since 2021. That 7-week winning streak for the S&P, the longest since 2017.
Everybody piling in.
Yeah, seriously.
Let's get to some trending tickers here too. Broadcom rallying, having its best week ever. Move today driven by a note from Bank of America. Yeah, this stock, so great run for CEO Hocktan's company. Great week, great year. Stock is now up only about 102%. Julie, that's
only
that in 2023. Bank of America did come out with that new note. They've got a buy. Analysts saying there he met with the CEO, he met with the CFO. Clearly liked what he heard. They raised their target to $12.50. Says they like what they heard about the VMware acquisition, the strong multi-year visibility, they say, into Gen AI, the stability of the non-AI legacy business. They tell clients Broadcom is that rare combination, compelling valuation and free cash flow generation. Not surprising. We know analysts who cover Broadcom tend to be bulled up on that name.
Yeah, the stock up 20% this week alone. I believe that is the best week ever for this stock, and it's at a new record as well. By the way, it wasn't only Bank of America out with commentary on the stock today. JP Morgan out with a broader look at semiconductors. And they're optimistic on semiconductors generally. They say we're at the cusp of a semiconductor up cycle, which would be 4 to 6 quarters of positive year-over-year growth. They said industry revenue growth should turn positive year-over-year in the fourth quarter, this what we're in right now. And they said that should persist then through the next couple of years. They're talking about that demand recovery has been uneven, but they do like Broadcom, Marvell, as well as Micron within the semiconductor space.
And we always remind people, even if you're not in chips, you pay attention to chips, because strategists are always quick to point out, lead the market on the way up and lead the market on the way down.
Yeah,
typically.
Definitely. All right.
I'm sorry, go ahead, Julie.
Let's talk Roku.
I'm just so excited about Roku. I had to jump in.
You're so excited about Roku. The stock is down 7% today. It was downgraded at MoffettNathanson to sell from neutral. Michael Nathanson writing in a note that it seems like it is a lot to do with valuation here and the movement that it has had upward quickly. And they think that 2024 is not going to necessarily compare favorably from a revenue perspective for Roku, so that the recent surge isn't justified.
Yeah, I mean, to your point, listen, this stock has had a remarkable run. It's up about 140% this year. So after a surge like that, it's not surprising you get analysts who get a little bit more cautious, right? And that, to your point, is what MoffettNathanson is really saying here. Valuation stretch relative, they say, to kind of some top line risks they know, talking about they see a kind of challenging compares for the company. Not many sells like MoffettNathanson, though. It's worth pointing out they are in the minority, but plenty of financial analysts with a hold. We should note that.
Yes, given the run that it's had, that is
not a shocker.
Not that surprising.
And finally, let's get to Palantir here, closing the day slightly lower, but it's been trending all day on Yahoo Finance. Company getting a 1-year extension to a previous 4-year contract for the U.S. Army's Vantage Data Management Program. So that was the news here, Julie. The headline that Palantir got this 1-year extension, this previous contract with the Army, worth $115 million. Analysts who cover the name quoted as saying here this was unexpected news. And remember what Palantir does. It's a data miner, right? So it's software basically allows customers, you kind of integrate just volumes of disparate data, images and spreadsheets into a central platform where it can then be analyzed and interpreted. And it has been a good year to be in the same. The stock's up about 190% in 2023. Yeah,
this is a fascinating one to me. Not so much because of the story today, which is a fine piece of news, I guess, for Palantir. Not because the stock's not doing much. It was on our trending ticker list all day long, even though it wasn't moving much, even though this news seems incremental. But it just says to me that there are these certain stocks that investors are interested in right now.
Yep.
And Palantir appears to be on that list of stocks. So I just think it's an interesting one from that perspective.
And our buddy Dan Ives over at Wedbush, who just put out a note this week about kind of looking at the tech sector broadly and why he's bulled up. And then he talked about his favorite tech names. We should mention.
He has loved Palantir.
Loves Palantir. Big Palantir guy.
We're going to have him in here on Friday. So
that's a good get.
We'll see if he talks about it.
I'm excited about that one. Yeah. Moving on here, Chicago Fed President Austin Goolsbee is saying it might be time for the central bank to shift focus from inflation to the slowing labor market. Goolsbee making the comments in an interview with the Wall Street Journal. Lowering inflation has been the Fed's primary concern over the past year, but Fed Chair Powell acknowledging Wednesday we're at the point where maximizing employment is just as important to avoid recession. Here with more is Claudia Sahm Consulting founder and former Federal Reserve Board economist. And Claudia, before we get to that, can you help us unwind something we've been talking about this show? We started off the show. I'd love to get your take. Where the Fed is at exactly, Claudia, because we had Fed Chair Jerome Powell. He takes the mic at that presser. Markets took that when they listened to Fed Powell's, okay, time to party, cuts are coming, we're doing the pivot, rallying stocks, rallying bonds. But today then, Claudia, as I'm sure you saw, the Fed's John Williams says, well, hold on so fast, we're actually not even thinking about cuts right now. How did you make sense of all that? Was John Williams just trying to calm the party a little bit, Claudia?
I think John Williams had a bad day. I don't think he was trying to upset markets. So yes, listen to Jay Powell, right? Like start there, stop there in a lot of ways. And it was really positive news on Wednesday. I mean, for them to mention the dual mandate again as really like we're looking at both sides is huge. Now the markets are the market. They got a little more excited than I think they probably should have, but go for it. I mean, this was a really positive moment. He said, we're talking about the cuts. And really, you could see him up there being like, we're getting that soft landing. Like they have the data. We see the runway. Now, I can only speculate, but what happens once we get out of the blackout is then you have the rest of the FOMC officials marching out and selling their dots, right? Because we don't know. Austin was clearly telling us he's one of the happy dots, right? With lots of cuts. This is not surprising. He's a dove. John Williams is almost certainly in the median, like the typical dot, and he's probably, very much the FOMC, and they probably looked at the markets pulling everything to March, and we're like, whoa, we didn't mean that. And so I think the idea was probably to nudge it a little bit further. I'd say probably they're thinking June, but that's hard to nudge, right? Like I'm not good at nudging either. So I think, and people that he contradicted Powell directly saying we're not talking about cuts. I think that was what got people to be like, we're just going to ignore you, right? And that's not good.
It did feel a little bit. I mean, as we said earlier, Powell talks and the market hears kind of what it wants to hear sometimes, which is what happened again. But I guess the question is whether indeed we're going to get this soft landing that everybody's been talking about, right? I know, we have the SOM indicator that you've talked at length about, which is not indicating a recession right now. What's your optimism level?
My optimism level has been high throughout that this would happen. In the last week, from getting the jobs report where the labor market really looks balanced, people are still coming in, the unemployment rate kind of ticked back down. Labor market looks good. That takes a lot of pressure off the Fed. They've been worried about the labor market. That seems to be okay. Then we got the consumer price index. That looks fine. I mean, inflation has slowed dramatically this year without losing growth, without losing jobs. And then the producer price index, that was a nice surprise for FOMC morning. Like, that was another good. So it's like there's actually reality on our side for the soft landing. Last year it was an intellectual argument, like that this inflation would unwind. And like, it's happened. Now, there's going to be a bumpy ride. I don't expect all the data. I mean, they're only going to get 2 more inflation reads before the March meeting. Those 2 are not going to both be happy. I mean, data's noisy, right? So, but it's clear we're getting there, and it's based on data, and it's like, wow, we're really going to do this.
So, Claudia, we're really going to do this. We're really getting there. Let me ask you this: when do you think you could see cuts next year, Claudia? What time frame? First half, back half? How deep would they be? And what does that depend on, Claudia? Does the Fed have to see core PCE, come back to 2% and stay there?
Well, they're going to cut before they get to 2%, or at least that's their intention. If they wait too long, they might not. No, I think they're going to want to see continued progress. My thinking is whatever you think the Fed should do, or not even should do, what you think the Fed would do, likely put another meeting on it, right? Like, this is a very tough situation. They're trying to do the pivot and start cutting. It's in an election year. They're just going to be more conservative. And that's where Powell was so encouraging, because it's clear they are not the first cut towards the end of the year thinking, right? So I think it'll be a little slower. I don't think it'll matter much. The U.S. economy is in a really good place. They can kind of buffer the Fed being slow. And I mean, frankly, market rates are what people pay, and they've started to ease up already. So I think it's good, but we'll play the guessing game with the Fed. There'll be high drama over something that largely doesn't matter to the economy, and it's really hard when you have all these officials out saying stuff without any coordination.
Yeah, lots of noise for sure. Claudia, I want to finish with this. What are you still worried about? What's the biggest risk in the coming year?
Right. So we always should take time to think about risk. That's honestly probably the most important thing that we do as forecasters, is to look out at those. My 2 big risks for next year are, one, the Fed blows up financial markets. I mean, that they create enough uncertainty, something breaks, and it transmits then into the real economy. And the other one is that politics blows us all up. I mean, it's an election year. Things are really contentious. I don't know how that would transmit to the economy, but that is something that I'm worried about. So those are my 2 risks. I don't put real high weights on either of them, but that's unless something else unforeseen could happen. We've had a lot of bad luck the last 3 years, but these are risks, not the base case.
I'll knock on the plexiglass that makes up this desk. Claudia SOM, great to see you as always. Thanks for your time. I appreciate it.
Great. Thank you.
New data from Redfin showing there might finally be some signs of life in the housing market. The recent decline in mortgage rates driving more activity as listing, pending sales, and price growth all hit their highest level in roughly a year. Joining us now, Redfin chief economist Daryl Fairweather. So Daryl, is it just a matter of rates are down, so things are improving?
Yes, in the short run, whenever rates come down, conditions improve. Just in the last month, rates have come down enough that a typical home buyer will save hundreds of dollars monthly on their mortgage payment. So this is a big deal. It's a big difference. Rates are still high, but any improvement is welcome.
And Daryl, let me ask you, so according to Mortgage News Daily here, I'm looking at the 30-year fix. They say it's at 6.64, Daryl. I'm just interested, where do you think we head from here? Could we, in 6 months, could we knock it on 5%, maybe even lower?
I think that is an important question. We were forecasting that rates would fall to 6.6% by the end of 2024, and we're already practically there. So does that mean that rates stay stable from here on out? It really depends on the trajectory of the economy. If inflation comes down faster than what we're expecting, there is more room for rates to fall. But I think the best guess is always that rates will stay where they are as long as nothing's changing.
And what's going to happen on the price front? Because we still are seeing prices go higher.
Yes, prices keep going higher because the fundamental problem with the housing market is a lack of supply. There is very little inventory on the market. We're starting to see some signs that might let up next year. We're getting more inquiries from people looking to sell next year. So we're anticipating more new listings, which would facilitate more sales, about 5% more sales. You know, we're still comparing ourselves to probably one of the worst years on record for home sales. So 5% increase doesn't get us back to where we need to be, but it is an improvement.
And Daryl, let me ask you this, because you also noted something interesting, that deals are still falling through, I believe you said the highest rate on record, Daryl. What is going on there exactly?
Well, with rates being so volatile, it makes people second guess their decisions. A buyer who locked in a home just last month and is still in escrow, they may be seeing that rates are falling and they may want to get out of that deal and wait until next year when they're thinking there might be more inventory, better selection, maybe even lower rates. So anytime there's a lot of volatility, it makes people second guess. And also sellers are second guessing it too. If a buyer comes to them and says, hey, you know, there's something wrong with the house. This roof is older than what I thought it was, or it needs more maintenance than what I thought. The seller is going to be less willing to give a concession if they think the market is going to be more favorable to them next year. So all this volatility just makes it so sellers and buyers can't really see eye to eye.
At the same time, there are some markets where things are going well. Anaheim, California, for some reason, 18.7% increase in pending sales. What's going on there?
California is really interesting. Southern California. Los Angeles had a big correction with home prices coming down and people leaving the city to go to some of these other nearby places like Anaheim or even San Diego. This year, San Diego home prices actually exceeded Los Angeles home prices for the first time. So I think part of that has to do with remote work and changing preferences over where people want to live in Southern California. LA is great, but you know, Anaheim is a bit closer to the beach, closer to Disneyland, and maybe people think those amenities are more valuable now with remote work.
Yeah. I just live in constant fear, Daryl, that my 4-year-old's going to ask me to go to Disneyland. That's the biggest nightmare I have.
Really?
Yeah. No.
Talk about inflation, right?
Daryl, thank you so much for joining us today. Appreciate it and have a great weekend.
You too.
And coming up, we get the outlook for ESG investing in the new year. That's on the other side of this break.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again. Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
A lot of stories and a lot of back and forth coming out of the COP28 conference over the past couple of weeks, but the biggest headline was an unprecedented agreement between nearly 200 countries to phase out fossil fuels. And that language is important, by the way. With an energy transition imminent, investors are trying to navigate a complex ESG space. For more on ESG's the newly inked climate agreement, we turn to Aniket Shah, Jefferies Managing Director and Global Head of Sustainability and Transition Strategy. And I believe they actually used the word transition rather than phase out, which was an interesting choice, Aniket. So now the COP is all said and done, what do you make of the sort of many criticisms of that agreement?
Sure. It's great to be with you, and thanks for having me. It's very easy to be cynical and pessimistic these days. And it's especially easy to be cynical when it comes to climate change. You see global CO2 emissions have not yet peaked, despite all these conferences. This is the 28th gathering of the Conference of Parties, and still emissions have not even peaked, let alone declined. But I am optimistic. I think COP28 was a very important moment because it outlined some very clear intentions, a tripling of renewable energy capacity as a goal from now to 2030, a reduction to essentially zero of methane leaks from the 50 largest oil and gas companies, and on and on. There's real stuff that is being discussed on the sidelines here. There are real commitments, and what we all have to appreciate is real money is moving, Julie. We have $1.8 trillion that will be invested in low carbon tech this year, up from $350 billion the year the Paris Agreement was signed. And the IEA has told us that we've already shaved 1 degree Celsius off of what we thought the world would get to by 2100 since the Paris Agreement. So there's good news to celebrate. There's a lot of work to be done, but I leave the COP28 news cycle with more optimism and more excitement than ever before.
I mean, at the same time, all of these agreements that are signed, and yes, you gave some examples of investment, but you know what they say, the road to hell is paved with good intentions, right? Elizabeth Kolbert of The New Yorker saying, what matters is not the language countries agree to, but what they actually do. So what are you going to be watching most closely in the coming year, both in terms of commitments, but also in terms of, for that matter, what you do and what I watch, which is investment opportunities?
Sure. So look, there is a conundrum at the center of the energy transition discussion right now for investors, which is 2023 was a banner year for renewable energy. It was a banner year for electric vehicles. In the real economy, you saw a 35% increase in electric vehicle purchases. You saw more solar installed in China this year than all of the rest of the world last year. And yet in the financial markets, investing in the energy transition over the last year has been a very poor investment. And you've seen the clean energy index underperform the S&P 500 by 40+%. And a lot of the darlings of the energy transition have similarly underperformed. And so both of those stories are true at the same time.
I'm more optimistic about energy transition stocks going into 2024 for two main reasons. One is that we're starting to get a sense that interest rates may have peaked and will start their descent downwards. So much of the play of investing in public equities in the energy transition is a rates play. And that's because these are capital expenditure heavy businesses. So they're very sensitive to interest rate hikes. And the second reason I'm optimistic is many of the major challenges that we now know are challenges to the energy transition, whether it's electric grid investments, whether it's human capital that's needed for energy transition. These problems are being solved, and they're being solved by national governments, and they're being solved by local communities. So long story short, I think a lot of the bad news for equity investors is in the price, and we're starting to see a more positive story in COP28. Yes, it is words on a paper, but it gives you a sense of intention. It gives you a sense of signaling. And it would be wrong to say that nothing has happened since the Paris Agreement. A lot has happened, and we're going to see more and more of that in the years to come.
Annika, I want to switch gears to a related theme that has been affecting certainly this kind of investing in the U.S., and that's the sort of political backlash against what has been called ESG. Just today, we had more subpoenas from the House Judiciary Chairman Jim Jordan subpoenaing some documents from BlackRock and State Street. He has been critical. He says there's collusion in the industry over ESG investing. How are you guys inside the industry talking about this, responding to it, seeing any evidence that it's hurting investment?
The ESG community needed to be a lot more clear about what its intention was than what we saw over the last few years. If ESG is about enhancing returns, which is what we think it should be about, if ESG investing is about analyzing a company's intangible assets and the pricing of its externalities over time, then there's very little to debate about whether or not it's legal or illegal or any of that. When ESG became this sort of moralistic crusade to try to solve all the world's problems, whether it's climate change or gender diversity or whatever that might be, it found itself in a bit of a challenge. And I think the Republicans identified these various different raison d'etres for why ESG exists and what was in the marketing materials and what the asset management community was discussing, and now are driving a truck through those holes. So again, the headline is, for the investment management industry, be very clear why you're doing this, which is that it has to be to enhance long-term returns. Be very clear and document what in fact you are doing, and make sure you're not breaking law. Make sure you're not breaking antitrust law. Make sure you are having good counsel and so on. And as a research strategist, as someone who is out there advising investors, as you know, Julie, I've been highlighting some of these shortcomings in practice for the last several years, and I think it's just starting to come to fruition. So the backlash is real. Many of the arguments of the backlash need to be contended with, and I think we're going to see that play itself out, not just over the next few weeks and months, but I think over the next few years.
Well, I look forward to continuing the conversation, Annika, because indeed you have been consistent in that message. We'll see if the community starts to hear it in a broader fashion. Really appreciate your time this afternoon. Have a great weekend.
Thank you so much. Take care.
You too. Coming up, a tough year for startups, but our next guest sees hope on the horizon in the new year. We'll discuss after the break. corporate America has a new set of cybersecurity rules to follow starting December 18th. And it could mean you'll start learning more quickly and more frequently about cyber attacks. The new standards from the Securities and Exchange Commission require companies to disclose a breach within 4 days of determining that hack will have a material impact, meaning it'll cost the company.
You're going to get an increase of cyber disclosures and regulations, and you're going to see more and more of these happen over the course of next year. You're going to be able to take a look at and compare, why did a company disclose this when their competitor didn't disclose this? You're going to look at the extent of the disclosure, and you're going to find investors, activist investors, regulators holding an even higher bar up to the level of oversight provided in cyber across many companies.
On the other hand, this could give a boost to cybersecurity businesses.
We see in the background of all of this more coordination among attackers, increasing levels of attacks, and now new SEC reporting requirements that require very timely disclosures. So we do think that this sets up constructive demand tailwinds for the entire cybersecurity industry, for those best-of-breed platforms, and companies also that can provide real-time analytics and risk visibility.
While this may give investors and regulators more information, companies have argued it'll be a challenge to comply.
Here's the thing, the adversaries, the attackers, the people behind these attacks, they've also jumped on this as well. So they're using that opportunistically. So if they attack an organization, they're trying to hold them to ransom and say, hey, if you don't work with us here, we're actually going to report you to the SEC. And we're actually seeing examples where attackers are compromising organizations. They're doing the reporting for you. So it's an interesting time. A lot of organizations are trying to work out how can they find out fast enough? How can they report to the SEC? How can they get that information out to their shareholders? We can help you understand how to report and how to be more compliant to these new regulations. We do that for companies around the world.
It's been a tough year for startups, burgeoning companies contending with record inflation, high interest rates, and a tough fundraising environment. But our next guest says there's hope on the horizon for the new year. For more, we turn to Jason Mock, head of startups at Brex. So Jason, thank you so much for joining us. And maybe before we get to your outlook for 2024, certainly plenty of lessons learned in 2023. A few different ways we can start here, Jason. Maybe certainly we could look at SVB, the collapse of Silicon Valley Bank. When you think about that drama, I know it seems like 10 years ago, but when you think about it, what are some lessons learned, you think, for founders listening right now?
All right. Well, first of all, thank you, Julie and Josh, for having me. I appreciate it. Yeah, it's crazy to think about it. I mean, yeah, it feels like forever ago, but reality was, 10 months ago. And so there were a lot of learnings, but as we acknowledged in our report, the big thing was one, capital preservation. And so a lot of founders did not, and it goes in ebbs and flows, but did not really come prepared to deal with something like this. And so especially for early stage founders, many don't have cash management strategies in place. And so a lot of learnings that came out of that was just like, one, aligning with your board and your lead investors on what your cash management strategy might be. Then kind of having in order, like the idea of capital preservation, making sure that you're preserving the dollars invested in you and you have access to that. And so making sure that you're aligned with an institution, FDIC insured, is my capital safe? And then thinking about next, liquidity, is it liquid? Making sure it's not tied up in laddered investments or stuff that's tied up for a bit. And then also thinking like, how do I align everything on one platform for, payments and all the bill pay and the payroll and everything else, and then kind of having multiple bank accounts tie into that. That way you really understand kind of where you're pulling from, and you can kind of make sure that everything's consolidated in one place when you're thinking about funding and operating your company. And that's a lot of the learnings that founders came away from. Where the takeaway is post-SVB.
Jason, one of the other things that we were watching this year on the big public side, as we talked about with some guests earlier in the show, is a lot of cost cutting, right? We saw a lot of more austerity coming to large cap tech. But judging from one of your observations on travel, on business travel among startups, they weren't necessarily getting that same kind of discipline.
Correct. What we acknowledged in the report was that travel is back. And I know we know that. We feel like as many of us travel and we're at the airports and we see it. But we've seen travel come back, T&E come back pretty aggressively since 2023. We'll see in 2024, we're expecting it to get back to pre-COVID levels, 2019 levels. And what we noticed, what we acknowledged is, again, coming out of COVID, a lot of companies obviously still remote and hybrid, and whether that be for offsites, get-togethers, and even attending industry conferences, travel is back, and it's actually one of those line items that we expect and we see continued uptick as you kind of see other things like offices and office space and whatnot be a reduction in cost. And so it's something that we definitely saw on a global scale. And acknowledging global, a lot of companies are hiring internationally, right? Canada, Latin America, Europe. And so a lot of that is better talent, as well as kind of managed cost. And so as you have more of a globally located company, a lot of travel is going to be involved, obviously, to get people together and to riff on new strategic ideas and whatnot.
And Jason, another thing you touched on here is the theme of trust and governance. Certainly we think about the drama with Sam Altman and OpenAI. Some big takeaways for you on that theme in 2023 for founders?
Yeah, I mean, that was a couple weeks ago, and so a late entry to the party in terms of just kind of thematic for 2023. But I mean, you hit it right on the head. In the report, we just talked about how the importance of governance and trust, and so. Especially for early stage founders building out their boards, being really thoughtful about building diversity amongst many different avenues. And so thinking about skill sets, industries, tenure, experiences, all the different types of board members that really can kind of help complement an organization and build a level of good, solid governance and trust. And so it's something that, again, late in the year, but a friendly reminder that great companies are built on great founders and also great governance. And it's something that we definitely implore in the report as a friendly reminder for founders to think about, especially in light of everything that happened with that crazy weekend with OpenAI.
Jason, we talked to somebody earlier in the week in the VC community who said next year we could see some startups shutting down. Not that it'll be a bad year overall, but he said it could still be a tough year. What do you think on that front?
I think it's part of the industry, right? So there's math all over around what number of seed, Series A, Series B companies actually make it. And I think it's par for the course, right? There are a lot of companies that raised at excessive valuations in 2020, 2021, and a lot of those reserved a lot of that cash in 2022 and 2023. As we acknowledge in our report, there were a lot of things around managing costs, extended runway, and whatnot. And so some companies right now are going through some pain, and a lot of that's going to come out in 2024. And I don't think it's bad for the industry. I think it's part of the evolution of how companies scale and the way innovation works. But there are going to be some companies that do shut down, and admittedly, we're feeling and we're seeing investment pick up. And so there are also going to be a lot of companies taking their place, and there's a lot of activity. I think there are a lot of reports out there just kind of sharing the amount of venture invested in Q3 and what we expect to see in Q4 and in 2024.
Jason Mock, good to catch up with you. Thanks so much. Appreciate it.
Thank you for having me. Take care.
You too. Coming up, all that glitters is gold. We reveal the product that earned Costco $100 million last quarter. That's next.
Welcome to Yahoo Finance's group chat with me, Brooke DePalma, alongside Alexandra Canal and Pras Subramanian. Today we're kicking things off with Costco's Gold Rush. The wholesale giant revealed that they have sold, get this, $100 million worth of gold bars in the last quarter. Now, they did announce that they were selling these on their website back in September, which really garnered a lot of attention, a lot of excitement. But we now know the total price tag of how many they sold, or rather how much they made from how many they sold. They did go for about $2,000 online, and Costco members were only allowed 2. So you have to imagine that so many people got in on this deal.
Yeah, the pricing is interesting. Selling for just under $2,070 an ounce. Current price of gold around $2,033. And, you know, gold has been on a steady incline, I would say, above 10% year to date. A lot of analysts out there think the price of gold is going to go even higher, especially as the Fed cuts rates. They're forecasting 3 more rate cuts in 2024. So this is just an interesting, I didn't even know you could do this on Costco.
Costco, of course.
Costco,
I feel like they can do anything.
Like dollar hot dogs, like gold if you want
Teddy bears.
Yeah, but it's interesting to see more people wanting to get in on this action. And I do think Costco, too, as a whole, the shopper base, the user base, I would say that they're not, you know, investors of any kind. So it's an interesting
more
play.
Traditional.
Yeah, more retail investor. It's an interesting play to get them involved in the commodity.
Yeah, I mean, you want to see that cross section of Costco members and gold bugs. I think are a little bit high. I know my mom likes gold, so I can see how people who shop there will like that kind of that. I mean, you're basically buying at cost. I don't think Costco's making that much money off it. But you know, I got to say though, you know, it's easier to just buy the GLD, right? Like, why are you buying these 2-ounce or whatever ounce bars of gold?
Where are you putting these 2-ounce bars?
Yeah, you need it safe. You gotta house them. You gotta have custody of them. That's not for me, but I think for people, Costco ilk, they kind of love it. They want to have it. They want to like maybe use it to shave off a couple things.
Well, a lot of people think it's nice to hold an actual tangible
have an actual
gold.
tangible asset.
You think, you know, a lot of naysayers out there, who knows what's going to happen with the stock market, the government. At least I have my bar of gold to get me through the tough times.
Costco bar.
Yeah, zombie apocalypse. You never know.
At least you have that bar of gold. But I do have to say also, too, this goes as Costco really doubles down on e-commerce. We're seeing them really build into this. They also said that they have a Mickey Mantle autograph signature 1951 rookie card on sale for $250,000. So as they really double down on e-commerce, they're bringing in these interesting, unique items on their marketplace, really entice customers to go on. Of course, I'm not sure who's buying a $250,000 Mickey Mantle card, but it's out there, and he said keep a look at it if you're looking for last-minute shopping ideas. So
interesting.
Goods.
Yeah, well, while there might be a gold rush for Costco consumers, there's also another gold rush going on in the streaming wars, and this gold rush is related to sports. And guys, we've really seen an explosion of these media companies going after sports and really harnessing sports as they look to really enhance their streaming hand moving forward. You have Disney committing plans to take ESPN fully over the top as a direct-to-consumer streaming service sometime in 2025. You have Amazon's Thursday Night Football, Google's Sunday Night Ticket on YouTube, Peacock, Paramount Plus. They've said how intense sports is. And although sports is sort of the last frontier, really holding that cable bundle together, we are also seeing all these companies, these legacy media companies saying, but we know our audiences are on these streaming platforms, so we at least need to have a presence there. And I think that's going to change the way we really consume content in 2024 and beyond.
Yeah, I think there was a Hollywood Reporter article, I think it was today or yesterday, talking about this, and a really good point that the author made was that are sports a critical piece of the value proposition as they are for Peacock and Paramount Plus, or are they a premium option worthy of an extra fee, right? So Max is going to charge $10 more for some of the sports offerings like March Madness. Like, is that a better way to actually package the service? Do I need to have Peacock have all this sports bundled in and cost more for me if I don't want sports? Another interesting tidbit in the article is about Roger Goodell, NFL commissioner, saying, hey, I don't want to go fully digital. I want to see how these guys can handle mass sort of quantity of people logging on and watching our games. I don't want our games to get crashed and then lose the service. So Amazon doing a good job, and we know they can do it. They have the ability. Question is, can other streamers handle the massive audiences of the NFL?
Yeah, and I thought that Black Friday game was really a pivotal moment for Amazon. We saw so many consumers flock to that on Black Friday, and it was such a, thinking of the e-commerce weekend, that just being the most critical point for shopping season for Amazon, them having this NFL game in addition to that really showed the broad array of offerings that Amazon does have. Really, they bundled it so nicely, but I just cannot get over how much money we're spending on these streaming services. I mean, max $15.99, and then you add a $10 service on top of that. I mean, that's a $26 bill.
Yeah, well, the pricing is interesting, and there's been a big conversation about whether or not the ESPN pricing is going to be more than what consumers are willing to handle. There have been rumblings that they would need to cost around a subscription to ESPN Plus, whenever that over-the-top service comes, would be more than $30, which is a heavy order. Yeah. Kevin Mayer, we spoke with him at Yahoo Finance Invest from Candle Media, and he said he believes consumers are willing to pay that because as sports enthusiasts, I mean, they want to watch their sports at the end of the day.
What does that mean for then YouTube? What does that mean for the Sunday ticket?
Question, yeah.
How much is the consumer willing to spend? And I did see a report out that right now the average monthly cost for streaming, people are paying $55 a month. I feel like I pay even more than that right now. Probably. So when you think of what's ahead, it's insane how much this could actually cost.
Yeah. What's ahead, you ask? Well, what about chat LGBT? It seems the dating app Grindr is jumping on the AI bandwagon, partnering with the company X-Human to launch an in-app chatbot. Now, look, what's happening here is my fam on Grindr, what they're doing is they're getting the help of the AI wingman, right? Wingman. It's like a dating assistant, helping them
inside the app,
helping them get through these sort of pitfalls of chatting on the app and meeting people. I got to say, in my dating days, I would have loved the help.
Yeah.
Well, we were talking about it.
Yeah.
Well, on the dating apps in general, I think if you are talking with someone, you hit a wall, you're not sure what to say, you talk to your friends.
You talk to your friends. Immediately you go to your friends. And so this, not having to screenshot the app, then send it to your friends, and then wait 5 minutes, then respond, this could help with that. But I have to say, I feel like this is it does collect a large portion of data to be able to understand how you would respond. And if it doesn't, then you eventually get to the date, and then you may have not been the exact voice that this person's used to hearing. I don't know if that human connection will really be lost in this AI technology.
And it's one of those things where the CEO of Grindr said, if we don't leverage AI first, if we're not the first mover in that, someone else will. And I was thinking about that because it's very true. You have to try it out, see how it goes. Will your consumers respond? Will your users respond to this? Is it going to be successful? Maybe not, but you have to try in this new world where AI is certainly present. It's going to continue to be present in the months and years to come. This could be something that they could leverage.
Right, and this company X-Human, which I did not know about, apparently does stuff like they make sort of apps that are like virtual girlfriends and virtual boyfriends. So they're in that industry. They're in that industry already. So they have the kind of, they can leverage that, get the data. Like you're saying, Grindr says they're going to be doing other things with AI, not just the dating assistant. But you got to imagine this could be. I think it's gonna be very helpful. But then again, what happens when it's like, I'm using my AI to chat with you and you're saying, how do I respond to this guy? Hey, AI, help me. And we're just the AI talking to each other and we're not talking to each other, right? That's what you were saying,
and then you meet in person. And then they also suggest places to go near you. So then eventually you're going to meet in person, and you just have to make sure that, you actually do have a connection with this person.
You still have to be able to talk to a human. That's
exactly.
That's point number one here. That's point number one.
Hey, give me the wingman. I need the wingman.
Pros wants the wingman. But coming up, we have what to watch tomorrow. We're going to break down the stories you need to know to start your day. Stay tuned.
China's ban on Apple iPhones is reportedly growing. More agencies and government-backed firms are instructing workers to stop bringing iPhones to work. That's according to a report from Bloomberg. Basically, we had already gotten the reporting that there were a handful of agencies in certain regions, but it was much more limited. And now this appears to be a growing situation.
Yeah, but what Bloomberg is saying, this is a pretty, in their words, major step up from September. That's when we heard about a small number of agencies telling their staff, listen, leave the foreign devices at home. And now they're arguing, again, this is according to Bloomberg, that there's been kind of a broadening of that effort, telling staff, don't bring these foreign devices. You know, they'd rather see them kind of rely on the home team. And there are, important domestic players like Huawei. If you're an Apple investor, you pay attention to these headlines because you know how important China is, right? It's such a key link in Apple's supply chain. It's such an important end market for Tim Cook's company. Stock is down about 0.5% right now in the after hours. Of course, it's up about 11% since they reported in early November, and it's up more than 50% this year.
Yeah, and you have to wonder if there's sort of diminishing impact here, even if there is this broadening of a ban. Is it priced into the stock already? Did people already expect or think that in the worst case scenario, this is where it would go? So I think we'll see. It's a Friday afternoon during the holidays. So one could argue there's probably a limited effect on the stock. We'll see on Monday if there's a carryover.
Keep watching. Here is a look at what to watch next week, the final full trading week of the year. Even as people head out for the holidays, there is a decent amount of economic data and earnings reports on tap. It's a busy week for housing in particular. On Monday, we're going to get the home builder confidence data. Then on Tuesday, we're going to get a look at future activity with housing starts and building permits. And we're also getting readings on new and existing home sales. Other economic data to watch on Friday, consumer sentiment and the Fed's favorite inflation gauge, the PCE index. As for earnings, a couple of key names to watch for, including chipmaker Micron, Carnival, and also Nike. Plus, all next week, we're going to be bringing you an investor's guide to 2024, everything you need to position your portfolio in the new year.
That'll do it for today's Yahoo Finance Live. Be sure to come back on Monday, 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a great weekend.